So good evening. Thank you for joining our presentation on Make the Right Mortgage Decision for You. My name is Tracy Resvani. I'm with the Montgomery County, Maryland Office of Consumer Protection. And this presentation is by our two members of our advisory committee on consumer protection, which I will introduce to you in a moment. So for those who may not be familiar with our agency, I wanted to take a brief moment to let you know what we do. One of the main services we provide to our constituents is that we handle disputes between merchants and consumers. So with some exceptions, if you have paid out money for a good or service, you're not happy with the result, you need help in trying to resolve the dispute, you can come and file a complaint with our office, and we will then be able to assign an investigator, have them look at the facts, look at the law, and try to help the parties and come up with a resolution. If you're not sure if what your rights are and you want to talk to someone, our investigators are available by email, and during the pandemic, email's best. They will call you back. Otherwise, we were able to have folks just pop in with no appointments or call us directly and be able to get patched over to an investigator right away. The other item that we do, obviously, we do a lot of outreach and education like this program. So if you belong to a civic group, a business group, a neighborhood group, or any kind of organization that you would like to have and invite us over to talk about any topics, we do that as well. Please make sure that you are following us on social media, Facebook, Twitter, or Instagram. We put a lot of consumer alerts out there about common scams, things to be on alert for, and how-tos, and just good consumer tidbit information. You should subscribe to our YouTube channel at ConsumerWise, and we have a lot of webinars recorded on there, so if you've missed any of our prior webinars, you can catch them on the webinar playlist. Last but not least, we are also a regulatory agency, so we license certain businesses in the county. If you're getting your car repaired, they should have a registration. If you are buying a brand new home, the builder and the seller should be registered with us. If you are having someone come into your home to repair your refrigerator or your stereo system, they should be registered with our office. And we also license secondhand personal property dealers, so pawn shops, high-end consignment shops, auction houses, things like that. So that's a quick rundown of the services that we provide in the county. So the Advisory Committee on Consumer Protection does just as the name implies. They provide our agency with guidance on where we should focus our attention, whether it's outreach or enforcement. As a law enforcement agency, if in the course of an investigation we find that the laws has been broken, we do have the ability to bring enforcement cases as well. Two members of our advisory committee are presenting today. One is Dan Kaplan. He is the chairperson of our committee, and he is a local residential mortgage lender. Philip Robinson is the Chamber of Commerce designee to our advisory committee, and he is a local consumer attorney. And without further ado, I am going to turn it over to them. If you have any questions, please put them in the chat box. And if it's some topic that I think it looks like maybe you're asking a clarifying question about something the presenter just said, I will interrupt them and ask the question. Otherwise, I'm going to leave your questions until the end, and then we're going to do a really robust Q&A. Because this program is being recorded, please don't share any personal information, because this will end up on our on our YouTube channel. So please, floor is yours.
Well, thank you, Tracy. It's always a pleasure to do these, especially with you and the people in your office, and with Philip, who's a very, very talented attorney and much more knowledgeable on the laws of consumer protection than I am. As a mortgage lender, I'm generally working with people on the front end, trying to help them get a mortgage that best suits their financial circumstances and their individual needs. But as a lender, not an internet lender, but as a lender, I work with people and want to stay with them and build relationships with them every step of the way. And I'm well known for quoting Cy Sims. And for those of you that remember the Sims department stores, their tagline was, "An educated consumer is our best customer." And an educated consumer really is my best customer. And that's at least half of what I do during the mortgage origination process when people are looking to buy a home or to refinance it. I want them to know what they are getting involved with, because surprises generally are not good news. And by the time that you need an attorney, it's usually because you're in some sort of trouble or in an insecure position, and we don't like to see that happen. The last thing I want to do is put you in a position by getting you a mortgage that does not fit your needs or puts you in over your head. And so I'll work with you to do everything that I can to prevent everything we're going to talk about today. But it's good to have people like Philip in case something goes wrong. And there are things that are well outside my control or even your control. Divorce situations arise, illness arises, job losses arises, the economy sours. You know, whoever would have come up with a 5-year plan 5 years ago and knew about a pandemic hitting, you know, nobody knew about these sorts of things. So that's why we want to have these types of presentations to help you if you are having a problem, or hopefully for most of you, that this is a preventative thing, that in case, hopefully never, but in case the situation arises, you'll know what to do. Because if I was to summarize the best thing to do if it arises, it is to be proactive. And the worst thing to do is to crawl under a rock and pretend that it doesn't exist. That will not help you at all. So that's my 2-minute spiel. Philip, yours?
Thanks, Dan. So my name is Philip Robinson. I'm a small business owner, resident of Montgomery County, and my law office is in Silver Spring, but I practice statewide and do stuff in other states as well. One of the lanes that I work in and help people on are mortgage issues. And for the last 12 or more years, a lot of that work has been involved with foreclosure issues. So my representation of folks is trying to help them understand what their rights are, what their solutions potentially are, and get them connected with what makes sense. And as Dan pointed out, the traditional reasons for foreclosure are a reduction of household income or a divorce situation, or some other issue. What's different in the last 14 years or so is that we now have economic crises leading to foreclosure, and now in the last year we've had a pandemic. So a lot of people are wondering what's right for them, how their loans can be saved, how they can keep their homes. So what we're going to do tonight is not be able to answer probably every specific question, but we generally want to provide folks with enough information so you have some idea of tools in the toolbox where you can go and what kinds of things will work for you. What we learned after 2008 was that most people couldn't get a straight answer from their mortgage servicer, the entity they'd make their payments to. They also didn't know who actually owned their loan. Most of the loans are sold and traded on what's called the secondary market, and you don't usually know who the owner is. So you need to know all that kind of stuff to sort of understand where you fit in the position. So generally, we wanted to have a conversation today, and we're going to cover some topics. And those are going to be, sort of including if you're a homeowner facing a potential mortgage default, or you've had a reduction of income, or the default's already occurred. What can you do, and what options are available to you? As Dan said earlier, we also are going to talk today about don't wait till it's too late. The worst thing you can ever do is put your head in the sand and think and be embarrassed about this situation. If you or a family member, or friend, or neighbor is having issues, they should not put their head in the sand. There's things that you can do. There's folks who can help you, and there are solutions. But if you don't do anything, you tend to lose options, and that's not a good thing. We also want to talk about in this session sort of advantages and disadvantages related to refinancing the mortgage, we're in a hot market right now, and because of all the stimulus going around, the interest rates are at historic lows. So does it make sense for you to refinance? And what kind of loans are being offered? And so talk about those. We'll also give you some advantages or disadvantages on loss mitigation, and that's sort of a term for getting a loan modification, or if you can't, or an exit strategy from the property if you're just not going to be able to understand the mortgage. And if you're facing foreclosure, and we've been on a lull, we're in a stay, most foreclosures have not been proceeding, but if you're facing foreclosure, what are generally your rights? And we could probably do a 4-hour session on that topic alone. So we're really just going to touch on it generally tonight. And I'll give you some ideas there as to what you can do. And so tonight's the first step in giving you some broad information, and we'll give you, places to go where you can get more help. I think probably the next slide, Trace. All right, so what's going on in the mortgage marketplace as a result of COVID-19? So I'll sort of start out here, and then I'm going to ask Dan to chime in from his perspective as a mortgage originator. But about a year ago, a little more than a year ago now, Congress passed the CARES Act, and the CARES Act provided relief that did not exist in 2008. So those of you who've been around long enough, you remember in 2008 when the mortgage market crashed, there were thousands of foreclosures filed and prosecuted immediately, and there was no governmental effort to freeze those foreclosures. The market was flooded with foreclosures of defaulted mortgages. CARES Act, Congress did something different. Congress basically created mechanisms to freeze foreclosures and the marketplace is completely different now than it was in 2008. So give you some perspective, and then I'll ask Dan to chime in if he thinks my stats are wrong. But generally, about 50% of all mortgage loans are owned by Fannie Mae or Freddie Mac in Maryland. And so what that means is they are right now governed and controlled by us taxpayers, and the federal government controls them. And so the CARES Act applies to Fannie and Freddie. And the CARES Act also put a freeze on FHA mortgages, and that's about 10% of the marketplace. So 10% of mortgage loans in Maryland are generally FHA mortgages. Then there's probably 5 to 7 or so percent of VA mortgages and other types of federal government mortgages and some state mortgages. So most of the secondary mortgage market, most of the mortgages that are out there are backed by or supported by the federal government in some way. So the CARES Act applies to all of those. They put in all these protections, and most importantly, an opportunity for forbearance. So if you were laid off, you had a reduction of household income, you could apply for and obtain a forbearance under the CARES Act. And they didn't know when they passed it exactly how it would play out, but that's something that's sort of new. So Dan, have you seen much on the CARES Act, or did I describe the marketplace correctly?
Yes, but I want to make one thing very clear. You described it well, Phil, but Fannie Mae and Freddie Mac are quasi-government entities. If you have an FHA loan or a VA loan, we refer to those as government loans, but it's not like you owe the money to the government. The government in those types of loans helps insure the loan, helps the lender who actually makes the loan, helps mitigate or minimize a loss in case of a foreclosure. So don't think that Uncle Sam is your lender, because they're not. That's number one. And you're right. The CARES Act did a lot of remarkable things and came about in a very short period of time and I hate this word because it's all we hear these days, in an unprecedented situation. But the devil is always in the detail, and people don't always realize, other than hearing a 2-minute soundbite on a news story, what some of these programs really mean below the surface. A lot of people applied for forbearance. Forbearance does not mean that you don't have to make good on your mortgage. It means that there can be a suspension of making payments to try to help people out. At one point, nearly 60% of the people that applied for the forbearance didn't need it. They just essentially wanted to take a break from having to make a mortgage payment.
So Dan, what you mean by that, I think, is 60% of the people did not have a reduction of household income.
Or not a significant decrease. Maybe they weren't getting overtime anymore, but they were still getting their base pay. But not enough of a hardship that they couldn't have gotten by and still made their mortgage payments without an undue or a particularly difficult time. I mean, we all have budgets in which we have to live in, but it did not, the current economic situation did not present a true hardship. Maybe, well, nobody was going out to the movies on a Saturday night, but, you might have to tighten your belt a little bit, but it did not present a true financial hardship that merited not having to make your payments. But people, thought, heck, I don't have to make a payment for 6 months. Why not take advantage of it? And the devil is in the details. The devil is in the agreement that you sign with your lender, because at some point you are going to have to make those payments.
Right. So I want to sort of say this in a different way. Dan's point here, I think, and he can disagree if he thinks I'm wrong. Some people got the idea that if they applied for and obtained a forbearance under the CARES Act, by making statements to their mortgage servicer, that they would not have to pay back that money. And that assumption was false. And so, and I've actually had just recently somebody come to me, very sophisticated person, who that's what their belief was. And they were upset that they had to pay back the sum of money. But a forbearance, the term is generally means we will forbear taking payments from you for a period of time, but you, at the end of that period of time, you will have to come to some agreement about how those payments get paid back.
And I have one question that I wanted to put with both of you as you talk about forbearance. We do have a question about what happens once the forbearance period ends and you have no proper source of income. Are there other government programs that would help with mortgage? I'm assuming you were going to weave that in, but I wanted to pin that.
Yeah.
Great question. So, and let me give a little history and then Dan can chime in. When the CARES Act passed, we did not know exactly what it was, how long the pandemic was going to go on for. So what's occurred over the last year is that most of the federal forbearance programs have been extended so that people who were eligible could continue those forbearance programs and keep the status quo. And so each of the programs, VA, FHA, Fannie, Freddie, Ginnie Mae, whether it's insured or owned or somehow controlled or identified or connected to the government, they all have different programs that are available for what you can do. So if you have income, one general thing that is available is you should be applying for a modification where the forbearance amount, the payments you haven't made, can get stuck on the end of the loan. Or they can be spread out over a year, sometimes more, in addition to your regular payments. But if you're not able to make payments at the end of the forbearance period and you can't apply for any more forbearance period based on your loan, then in one of the future next slides down the road, I'll come back to that part of the question. But Dan, you might have some other ideas though, I think.
Right, and again, forbearance isn't, you don't have to make the payment. It varies from lender to lender, and it varies from forbearance agreement to forbearance agreement. You will actually sign an agreement as to what those terms are. And if you are unclear or don't understand that agreement, I would highly recommend that you contact somebody who is competent and understands it, most notably an attorney. But it doesn't have to be an attorney, but generally it ought to be, that can help you understand and explain what the terms are. And there are generally two ways of getting that money paid back. As Phil alluded to, and I'm just making up simple numbers now, let's say during the term of the forbearance that you did not have to make $6,000 worth of payments. Under the forbearance agreement, you might have a year to pay that back. So when you start resuming your payments, you might have to pay $500 a month extra over the course of a year. Now think about that for a minute. And again, I'm keeping the math might not work because I'm doing it in my head, but I'm trying to keep it simple. Let's say your mortgage payment is $1,000 a month. And let's say the forbearance period ends June 1st. Your regular payment will resume June 1st, but under the agreement that I've just illustrated, you have to pay an extra $500 a month. So starting June 1st, you're coming off a period where you've not had to make any mortgage payments, but now you're going to have to start making a payment of $1,500 a month for a year until you're caught up. Conversely, again, as Phil illustrated, some forbearance agreements say, no, you don't have to make that payment over a period of time, but rather we're going to keep that, in my example, $6,000 sort of in a side category, so that when you either refinance your home or sell it, that money gets added to the principal balance and has to be repaid at that time. I've seen it both ways.
We'll come back to this topic a little bit on some of the subsequent slides, but in the big picture wise, just so we're all on the same page. So what else is going in the marketplace? Well,
can I just add one more thing?
Sure.
Under the CARES Act, one of the nice things about it for consumers is that if you do apply for forbearance, it cannot be counted against you in your credit reporting. So it does not lower your credit scores, for example, on your credit report. Now, what many people outside of those who have student loans, all federally insured student loans are in forbearance. You do not have to make payments. Now, that is all well and good. It helps consumers. You don't have to make student loan payments. You don't necessarily have to make your mortgage payments. But as an individual privately owned lender, I work for a privately owned mortgage company, or even as a bank, a commercial bank that's federally regulated by FDIC and the OCC and Federal Reserve, they don't have to abide by those same rules. So that while they can't count a forbearance against you, either when you're trying to buy a new home or refinance your existing mortgage, most lenders, primarily because it's been handed down from FHA and VA and Fannie Mae and Freddie Mac, have stipulated additional underwriting guidelines that make it a little bit more stringent to get approved for your next loan if you have been in a period of forbearance. So it's not perfect. It does help you out. And I would again encourage you to apply for forbearance, but only if you really truly need it.
So the other big thing next big thing in the marketplace that's going on is defaults. So we've seen actually in Maryland low number of defaults. There have been very few. The default rate is lower generally on mortgage loans. And primarily that's because a lot of people are in forbearance and that's preventing the default, the people who are have a reduction of income. But we are beginning to see the numbers come up. And the state will lift the moratorium on new foreclosure cases getting filed. And the feds will do that soon in a couple months. So we're going to start seeing more defaults and it's going to increase. So this is another reason of don't put your head in the sand, pay attention and get ahead of the thing. If you think your household income is drying up or you've been using your savings while you're unemployed or underemployed to keep the loan current, now's the time to start reaching out for resources that we're going to talk about in the subsequent slides. Dan, I thought the next thing in the marketplace you could talk about, it is one hot market right out there for sellers right now. It's really hard for people buying houses. What are you seeing in that, and how do you think that plays into our bigger topic that we're talking about here?
Before I jump into that, just one comment about that. If we have limited amounts of money to spend each month, I've oftentimes, more often than I'd like, have seen people that say, well, I'm going to make a payment on my credit card or credit cards, but not on my mortgage. Now, I'm not saying this because I'm pro-mortgage and anti-credit card, but a credit card is an unsecured credit facility. they can take your credit card away, but they can't take really anything else away. They can put a judgment against you for not making your credit card payments, but they can't take your home away. So if you have limited amount of money to spend, and again, I'm making a very generic and general comment when I say this, really seek the advice of a professional for your individual circumstances before you act upon what I'm saying. But you might want to consider not making your credit card payments, but making your mortgage payment or making your car payment so they don't repossess a car, because the ramifications of losing a car or losing your home are far more severe than your credit card.
Hold that thought, Dan. We'll come back to that in a future slide again. So
Okay.
tell us about the sellers.
The seller's market, I really do feel bad for people trying to buy a home. It is very competitive and is very tough. I've been originating residential mortgages. This September will be 36 years. I thought I had seen everything, and I am in many ways a firm believer that home ownership is part and parcel to the American dream. But I learned during the Great Recession of about a dozen years ago that it really is not right for everybody. And that is not a value judgment. Wearing a necktie is right for Phil, but I don't like it. Home ownership is not right for everybody. And as we both said, circumstances can change. Maybe it was right at a certain time and it's not right now. If you are facing financial problems, maybe before you have to think about a forbearance, and certainly before you have to think about a foreclosure or a modification, maybe think about selling your home. Unlike the recession of a dozen years ago, where people were faced with declining values and they had to have short sales, that means they were selling their homes for less than what they owed on it. And that very much negatively affects your credit. Today, there's a good likelihood that you will make money and even walk away with money, even if you're having financial problems, even if you are facing forbearance or potentially facing foreclosure. There is still the possibility that you'll walk away with money in your pocket from selling your home because the demand is so high and the inventory is so low.
So one of the things when people come to me and ask for advice for their situation, I always tell people who have equity in their property to consider selling the property. They don't like to hear that. People want to stay in their home, but I think it's malpractice for me not to tell everybody all their options, and that is an option. And then the next question that most people ask me is, well, where will I go? I'm like, well, you'll get $100,000 net out of the sale, and then you look to figure out where you want to go next. But if it goes to foreclosure, you won't get that $100,000. You'll lose it. So these are all things you kind of have to think about, and we'll come back to the next slides, who you can go and talk to about that kind of thing. But those are sort of big issues. Dan, the next big issue that's right up your alley is the low interest rates. So somebody who's had a reduction of income is keeping current on their mortgage with their savings. Should they consider refinancing their loan potentially because the rates are like ridiculously low?
Absolutely. And for most people, their home is their single biggest asset. And for most people, their mortgage is their single biggest debt. But most people also have other debt. And so if you are facing some financial struggles and have other debt, even if your interest rate is low, it might be in your best interest to consider refinancing and consolidating it to help lower your overall monthly payment, so that at the end of the month, your bills on a monthly basis are reduced. And there are ways of reducing your monthly payment for the totality of your debt obligations, and even reducing the term of the loan of your mortgage. So with these rates where they're at, even if you take a bump up in your mortgage interest rate, you might be better off refinancing if you can eliminate or consolidate some of your other obligations. Again, so much of this is really based on people's individual needs. We can give you tonight some very generic and general advice, But when I meet with my borrowers, and Phil, when he meets with his clients, really try to take our areas of expertise, which are very different, and tailor match it to what the individual client or borrower's needs are to maximize the benefits for them.
How about the next slide, Trace? Okay, so I am not delinquent yet, but I worry that I might fall short soon. Should I refinance my mortgage? Well, we just talked about that a little bit. I think the answer is you should consider that. Dan, would you agree with that? That's an option that should be on the
100%.
table.
And we, in fact, talked about those first two bullet items, and both of those, as you said, both of those are options, and it's important whether it's well received or not. I make the assumption that most of the people I work with are reasonably intelligent people. It's not my job to make a decision for them, but it's my job to hopefully be able to give them choices. And like you said, Phil, when you said you at least put on the table possibly selling your home, to walk away with that $100,000 in your pocket example that you used, Phil, that's nice to be able to take a time out and regroup and get back on track and at least exhaust all options and see what's really going to be best for you.
So one of the things that's a false narrative that lots of mortgage servicers will tell their borrowers, if they're current, that they are not eligible to apply for loss mitigation, a loan modification, a forbearance, or whatever else. That is an untrue statement. And so if you have a reduction of income, you're not yet delinquent, you certainly can apply for loss mitigation and should. And we have some free resources for folks we're going to point to in the future. But you should consider that if for whatever reason you don't want to look at a refinance, and there's good reasons not to do a refinance sometimes. If you're going to move in 2 years to go live closer to your grandkids, you may not want to do a refinance this year. You may want to try to do a loan modification just to reduce your lower payments for a couple years.
Let me address one thing, and I'm going to be on my soapbox for just a minute. And this is really one of my biggest pet peeves. And that's why I said earlier, you have to pick professionals that are knowledgeable and that you trust. And I first experienced this again with the Great Recession a dozen years ago. I heard way too many times people being given advice, well, just stop making your mortgage payments. It is, bar none, the worst advice you can be given. If you can afford to make your mortgage payments, do so. Do not stop making your mortgage payments just for the sheer ability to get a loss mitigation or a modification. It is very bad advice. And I've said all along that I'm giving you very generic, general advice. I can't think of a situation where I would recommend to somebody just stop making your mortgage payment.
If you have the means to do so.
If you have the means to do so.
And Dana's right. This was the #1 mistake that the mortgage servicers did 12, 13 years ago. And I have the audio calls to prove it. Their representatives were telling borrowers you can't apply for loss mitigation until you're in default. Once you're 3 months in default, then we can accept your application. That is just an untrue statement.
And that was across the board. That was mortgage servicers, it was lawyers, it was accountants, it was financial planners. It was across the board.
Don't fall for the ruse is what we're telling you. Should you do nothing if you're not yet delinquent and worry that I might fall short soon? No, my answer to that is no. There's no questions. Do not do nothing. That's a mistake. You need to do something. Seek help. So Trace, you want to go to the next one?
Can I just address the question that was put in the chat? It says, I'm not worried about my finances, which is good, but I'm not sure it is worth refinancing to reduce the rate and cut back on the years owed on my mortgage. I refinanced more than 5 years ago for the first time. It was worth it then, but I am not sure now. What should I consider to help me make a decision on the pros and cons of refinancing for someone who is financially stable? What is a loan modification? The question about whether to refinance or not, I think you need to talk to a lender who can basically help you do the math. And then you can decide for yourself whether it is worthwhile or not. There are times when you can refinance and it shortens the term. So I'm guessing, and maybe I'm right, maybe I'm wrong, that you took out a 30-year loan 5 years ago, so you still have 25 years to go. You might be able to reduce the payments, the interest rate, and the term, maybe to 20 years or 15 years if you were to refinance. But again, as Phil said before, there might be reasons why not to refinance. So I would talk with somebody that can give you an objective point of view on that.
I think Dan's advice is good, and I would say to you, don't allow the lender or prospective lender to tell you that they cannot consider you for a 25-year term or a 20-year term. They may not offer those themselves, but there are lenders who offer those. And if you don't want to extend your term out to another 30 years, then that's the product you're looking for.
Right.
And I have a very good friend who told me that she spent a long time, she refinanced recently, but the lender kept trying to steer her back to a 30-year loan. And she said, no, I want to keep, I'm at 20 years left on my current loan. I want a 20-year term. It took a long time to get it done. And the reason maybe the lender was trying to steer her to the longer term is they got a bigger commission off of that. But you need to look hard. And I think based on where the premise of that question, it sounds like someone that does work hard, are paying their bills, doesn't want to stretch the thing out forever. And that's what I would recommend, is at least consider if the rate's at 2% and you can get a 20-year 2% loan, maybe that'll be a little bump on your payment, maybe not, but it might be worth looking at.
And the last part of that question is, what is a loan modification? It literally modifies in some way the terms of your existing mortgage. But don't get your hopes up. Don't think you can call your lender and say, I'm at 4%, will you modify it to 3%? I mean, there generally has to be a reason of some sort why a lender is going to modify it. I mean, because really, if you think about it, a mortgage is an agreement. I agree to lend you money and you agree to pay me the money. When you go to settlement, when somebody says, what do all these papers mean? You can really summarize it. You pay, you stay, you don't, you won't. But if there's some reason, some legitimate reason for everybody to help each other, it's in a lender's best interest for you to be able to make the payments. But just for the convenience of getting a better rate, most lenders aren't either willing or able to modify it just for the sake of getting you a better interest rate. But a modification modifies, it changes the terms of the original loan, generally for some financial need.
Right. So the modification doesn't always lower your payment. Also depends on who the insurer or owner of your loan is. But generally, to lower it, there's like a couple different things that can happen, and you need to understand the ramifications. They can change the term of the loan. So if you have 20 years left on your current loan, but you're not able to make the payments, on a modification, they can sometimes stretch the term out to 40 years. I've even seen 50-year modifications. Well, over time, you're going to pay a lot more money in interest back on that kind of loan. But for the immediate purpose, if that's what your goal is, to reduce your monthly payments, that will significantly reduce the payments. They can also do interest reduction. So as Dan pointed out, so in the 2008, most people had loans that were in the 7, 6, 8% range. The modifications being offered back in 2008 were generally at 4%, which is above today's market rates, I think. So I'm not sure from an interest rate perspective, a modification makes the most sense if you're trying to reduce your payments. The third way a modification might reduce your payment is principal reduction. Most bona fide lenders or servicers, especially for Montgomery County residents, are not going to reduce the amount you owe. They are not going to do principal reduction. On occasion, you can get it in very complicated situations, but do not hold your breath out for that. If anybody tells you, oh, I can get you a principal reduction on a modification, just don't, you need to verify that statement. It's not likely true.
And don't pay for that service. Do
Correct.
not write them a check. Two other very quick points. Number one, on a modification, that does get reported on your credit report. So other lenders, future lenders that you might go to will see that you had a modification, and that does send up a red flag. Also, I just want to define a term that Phil has been using. He said a loan servicer. A loan servicer is the person or the organization that you actually make the payments to. That may or may not be the same organization that you owe the money to. Phil made reference before to Fannie Mae and Freddie Mac, for example. Your mortgage might be held by Fannie Mae and Freddie Mac, but they might have XYZ Bank servicing it for them. Fannie Mae and Freddie Mac, while they're the two largest owners of mortgages in the world, don't collect payments. And you can think of it as if you rent an apartment in an apartment building, you might pay your rent to the XYZ property management company, but they don't own the building. You know, the Smith brothers and sisters own the apartment building, but the property management company just collects the payments for them. So that's who the servicer is, as opposed to who the actual lender is.
Right. So Tracy, can we jump to the where can I go for specific help slide? All right, so the where can you go for help? We've been bringing this up. There are free, qualified by the state of Maryland housing counseling agencies available in Montgomery County. One of the best in the state, Housing Initiative Partnership and Latino Economic Development Corporation, and their phone number and websites are there. You can contact them, make an appointment to meet with them virtually, and meet with a qualified housing counselor that's been trained and certified by HUD and by the state, and is supervised by the state. And I would, and when I refer clients to housing counselors, these are who I refer them to. So that's one option for you. Why would you talk to a housing counselor or one of these agencies? So we've talked earlier about, and Dan made a really good point. If you got a lot of bills, but you can't pay all your payments, how do you prioritize for your particular situation what bills? Well, instead of talking to someone who may be biased and direct you in one direction to file a bankruptcy, for example, if you're talking to a bankruptcy attorney, you might want to talk to a non-biased housing counselor and just lay it all out, share all your financials with them and your situation, and they can help you think about the things that we're talking about today to your specific situation. And so I would recommend that. The state also runs a free hotline where you can call up and get a lawyer on the phone. It's run by Civil Justice, which is a legal service nonprofit, and you can talk to a lawyer on the days and times that are identified there on the slide and get specific free advice. You can also hire a lawyer and go do a consult with a lawyer and do that as well. But you know, you can do the brief advice and see how that helps you. Civil Justice also runs a low bono mediation program. I might talk about that a little bit if we have time later. For if you're in foreclosure, active foreclosure now, where they can get you to a low bono lawyer, not a free lawyer, but one that won't charge a full rate. So there are resources that can help you. And as we said before, don't put your head in the sand. Use these free resources and others. And I would say too that we want to also be careful that you don't fall into a trap of a scammer or a fraudster. So Dan and I have both probably had people come to us. I know I have, and I'm pretty sure he has, that they trusted somebody who was trying to help them get a mortgage loan or save their house. And it turned around, that person scammed them out of money that they otherwise didn't need to lose. So you don't want to just trust someone because they belong to the same group that you belong to. You need to verify what they do and what the services that they're providing. The tell that there's a problem is anybody who says you have to pay them money up front.
Right.
That is the tell, because most of the scam artists are the people who are too good to be true schemes. That's their ruse. They get you to pay them money and then they don't perform the services. And the law generally requires that you do not pay them until the services are performed. And there's exceptions to that, like there are in the law, but generally non-lawyers especially, that's the guidepost you want to go by.
Additionally, and I might be off on the number of years, but for roughly the past 10 years, federal law requires that when you take out a mortgage we're required to provide you a list of 10 nonprofit housing counseling organizations. These are all very good. Phil is right. But we're required, I think they have to be within a 20-mile radius of your existing address, not where you're moving to. And in some ways that's good or bad. I mean, if you're moving to California and you're living in Gaithersburg, that kind of makes it a little tough. But, within a 10 or 20-mile radius, I think, we have to provide you with a list of 10 nonprofit organizations that provide housing counseling and financial counseling, so that if you took out your mortgage in the past roughly 10 years and you still have your paperwork, you can also look there for a list of other resources as well.
Yeah, and these two agencies that are on this slide are HUD recognized agencies, probably on that thing you got 10 years ago. But the other agencies, there's been a lot of shift in this marketplace. So some of the agencies may not exist anymore. So just, you want to use your consumer hats, make sure that you're getting the services that you think you're actually going to need from someone that actually knows what they're doing. I think I wanted to make sure we had enough time for questions. So unless we want to go over any of the other slides, Tracy, I was thinking we could turn it over to questions.
Okay, I wanted to go back and see which ones we, hold on. Why is it doing this? Sorry.
Because it's IT and that's what IT does.
Yes. Forgive me, everyone. For some reason, the slideshow just disappeared on me. And now that my dog is barking, of course. We talked about loss mitigation. Did we talk about foreclosure or potential foreclosure options?
Yep.
We did that. Okay, and we talked about scammers as well. So yes, we can definitely open it up to questions now. And let me read some. I have a question. Will we have access to these slides? Yes, I can definitely send these slides around to everyone who has had a registration with us, so I can do that. And with the original email, I did have some documents that the panelists had wanted to make sure everybody had available as well. And then I do have some emailed questions, if you would bear with me. Do all servicers or mortgage companies work the same way?
No.
That was not planned.
The marketplace has changed dramatically. Back in the 2000s, the beginning of the 2000s, the mortgage servicing market was controlled by the banks, the big banks, Wells Fargo, Bank of America, Chase, Citi, and someone else I'm forgetting. But now the mortgage servicing market, at least with defaulted mortgages or mortgages that are delinquent, is primarily controlled by non-bank servicers. That's who I end up dealing with most of the time. And coincidentally, they all tend to be owned by private equity firms. So we don't have, it's a very different marketplace. Anybody that's ever watched It's a Wonderful Life, we do not have a George Bailey co-op system anymore with most mortgage secondary markets who keep the loans. They're sold off to other people, and these private equity firms are sort of controlling it. And you just have to document every communication you have with them, keep good notes, keep all correspondence you ever receive from them. Make sure you keep the envelopes because they tend to backdate information that's sent to you. And a lot of this has to be sent timely. And so that's constantly what I'm asking my clients to do because they just sort of can't be trusted.
And, and I'm not trying to self-plug myself here, but, if you're going to work with a lender, I really do feel it's important to work with a local lender. I'm not disclosing who I work for, my own credentials, but I find that with the internet lenders and the people that just don't have boots on the ground in this area, and I'd like to say Montgomery County, but in the state of Maryland or in the DMV, it's a far different story, and you're never going to deal with the same person twice. I mean, I'll be very blunt. I closed a loan a year ago, February. The servicing department in my company made a mistake, and the borrower got a little frustrated. These things happen. They happen with the best of companies. They contacted me. I elevated it to somebody in our servicing department, and it was taken care of within a week. So it's important to try to build these relationships. And if you're dealing with somebody that could be in China, because it's all internet driven, it's really hard to get that level of customer service. It's a bias that I have, but it's how I conduct all my affairs.
I always recommend
Will I ever order from Amazon Prime? Yes, but shy of that, I really do try to deal locally.
So I always recommend to my clients, if they're thinking about trying to refinance or take out a new mortgage, to stay with someone who's local or a credit union. And I think the good question to ask that prospective lender is, what percentage of loans do you keep? If they keep the loans that they originate, they're like George Bailey in that co-op. But if they're going to immediately transfer it to Fannie or Freddie or somebody else, that could potentially be a red flag. So those are good questions to ask.
I have two questions that I think probably would work well together. One says, I can pay some but not all of bills. What should I do? And should I think about bankruptcy? What would that do to my credit? So I think they kind of work together well.
Two things. The first part, I think, is a prime example of what Phil was talking about earlier. It sounds like that person really needs to contact one of the housing counseling people, because that person could probably be well served getting advice on how to balance the budget to the maximum extent that it's possible. The short answer on the bankruptcy question is, bankruptcy really does destroy your credit. Your credit scores drop to rock bottom. From the standpoint of getting a new mortgage after a bankruptcy, you're not going to be able to get a mortgage for a number of years. It depends on the type of bankruptcy you file, but oftentimes it's 4 years that you have to wait since the discharge. I always have to look at my cheat sheets. I know for Chapter 7, it's one period of time. For Chapter 11, it's another. But if possible and in your best interest, it's good to avoid the bankruptcy. And a bankruptcy stays on your credit report, I think, for 10 years. So that even though after a finite period of time, and it is a number of years, you can get and reestablish credit, it does leave that bruise on your credit report.
So I'm going to answer the second one first. Bankruptcy is a tool in the toolbox. I am not a bankruptcy lawyer. I think, depending on your situation, generally it's the last tool to think about. I'm going to give a hypothetical that might apply to some people. If you have a lot of complex debt, you have some business debt, you have a lot of credit card debt, you have some money, like the hypothetical had, you can make a modified payment. One thing you might consider trying is to modify your home loan. And once you get the loan modified and you're current again, you're still going to have all that other debt. Then you might think about the bankruptcy, if that's really what you want to do, if it's right for your situation and you can really get rid of all that other debt, unsecured debt. And so I think it's sort of a complex issue, depends on the circumstances, but you just kind of look at it. And I think that's just something to think about. There are a fair amount of members of my brothers and sisters in the bankruptcy bar that would tell you just to file bankruptcy right away. And I can't tell you how many clients have come to me after the fact where that was a major mistake. They should not have done that first. And there were other options, maybe even before they did a bankruptcy, and maybe they didn't even need to do the bankruptcy. I'll give you a good example of that. I had somebody who was facing foreclosure in 2009. The foreclosure was filed. She thought the sale was going to happen. She filed for bankruptcy. She was eligible to do so. She got discharged. She did the right thing and moved out of the house. She said, it's not right for me to stay if I'm not paying. And she moved on. Well, she came to me because 3 years later, her homeowners association was suing her for homeowners fees that had not been paid. Lo and behold, the mortgage company dismissed the foreclosure and never foreclosed. So after the bankruptcy, she still owned the house and she still was legally responsible for the homeowner fees. And the homeowners association wanted $12,000 from her for homeowner fees for 3 years. So I think it's just something to think about, and that's a good example of it. This is complex stuff. You need to get good advice for your particular situation, and don't believe the person that tells you bankruptcy is your best option right off the bat. You may have other options.
You know, I always find it interesting, two things. When you're facing financial difficulties, Phil was right in saying it's good to present all the options. Clearly, none of the options are perfect. You know, they all come with pros and cons, but it's good to have all the options presented to you. I always find it interesting that if somebody is having a medical issue and they talk to a surgeon and the surgeon recommends surgery, so many people say, do you mind if I get a second opinion? And they go for a second opinion. And that's perfectly fine. You know, it doesn't hurt to get a second opinion in other areas. And with the issue of bankruptcy, with something it is an option, and it's a very good and viable option in the right circumstances, but it doesn't hurt with something that significant to get a second opinion, either from a non-bankruptcy lawyer or from another bankruptcy attorney. So, you know, if somebody's feelings are hurt over the fact that you might want to get a second opinion, you're probably talking to the wrong person to begin with.
It's probably one of those red flags to make you think about, is just you getting the right advice.
Right.
And this probably segues into our last question really well. I can pay some, no, I'm sorry, not that. How can I stay in my home if I can't pay the mortgage? And I'm sure your first suggestion is going to be talk to a housing counselor about your options, but do either one of you have any overarching suggestions?
That's not my first move. There's a sort of a moral and ethical thing. And remember, I'm a lender. I want my organization to get their mortgage payments on time every month. But I'm also a human being. And, you know, the last thing, and the people in my organization are human beings. And the last thing we want to do is put anybody on the street. So the first thing to do, well, you know what, as I think about it, maybe you're right, is if you are very proactive, maybe the first thing to do is to talk to one of these housing counselors. But very shortly after that is talk to your lender. There are, and my industry has gotten bad publicity, justifiably so, because there are shysters out there. But most of the people in my industry are good, decent people, and they will work with you. You might disagree with this, Phil, and I'm sort of half joking, but not. And they will work with you. But there are enough out there that it's sort of ruined our reputation. So and the last thing, truthfully, that a lender wants to do is foreclose, because lenders do not make money off of foreclosing on a house. They usually lose money. And even if they aren't nice people, they don't want to lose money. So I would first talk to a housing counselor or another professional that's proficient and capable and competent to advise you. But almost immediately and very shortly thereafter, talk to your lender. And as Phil said, don't put your head in the sand.
So I think talking to the counselor is a good thing. Let me just sort of summarize the law in Maryland. If you can't make the mortgage payment, you're in default, you're facing foreclosure, or foreclosure gets filed. You may not be lawfully evicted from the house until the very end of the foreclosure process, which right now is going to take well into 2022, even if they started foreclosures tomorrow. So I think when you talk to the counselor, whoever you're getting advice from about what to do, when to move, it sort of depends on your personality and what you're comfortable with, what you feel is right. It may depend on your lender. Another option, we didn't talk about other loss mitigation options that for exiting the property. If you happen to be underwater, your house is worth less than what you owe, You can have the property listed for a short sale as another loss mitigation tool, and the lender will take less money than it's owed, and you sell it, and then you wouldn't have to do a bankruptcy, for example. So there's some pluses to that. It might still be a hit to your credit, but that's an option. Another option
in foreclosure also.
Another option besides foreclosure is a deed in lieu of foreclosure. Again, I wouldn't advise a client to do a deed in lieu unless they were really underwater. Potentially, the lender might pay you some cash to leave the house voluntarily before you're required to do so under the law. Typically, you have to leave it in broom swept condition and you can get a payment. I'm not seeing a lot of those right now being offered by lenders, but that is potentially another option. But if you want to ride it out and wait, I think there's no reason not to consider doing that. And I'm not so sure. I do agree generally that the George Bailey type lenders from It's a Wonderful Life, they lose money on foreclosures, no doubt. The private equity entities who have bought a lot of the marketplace are not losing money on foreclosures. That's not what private equity gets involved with. So I do not believe that they lose money. And I think the reason is because they have insurance and they've also not bought the loan for what you owe. So there's a lot of different pieces to the driving force or the marketplace here. So it just sort of depends, but you don't have to leave your house immediately. Under Maryland law, they cannot evict you until the very, very, very end of the foreclosure process legally. Now, there are instances where they will illegally lock you out, and then you should call a lawyer, and we can do something about that. But they cannot legally evict you until the very end of the process, which, because of all of the moratoria for the last year, it's not likely that they'll be able to evict you anytime until 2022, in my experience. And then, so you might have time to bounce back and see if you can work on some other options.
Okay, well, thank you to our panelists. I really appreciate your time and all of your really amazing tidbits and knowledge and experience that you brought to this program. For folks who may have missed the beginning of it, or perhaps you had connectivity issues, this whole program has been recorded, as we mentioned at the top of the hour. It will be on our YouTube channel, Consumer Wise. We have a playlist for webinars. And for those who registered and for the one guest who came in directly through the link on our calendar, I will circulate a copy of the slides as well as a link to this program once we have it up on our YouTube channel. If you have questions for the advisory committee, you can email them at ocp.advisory@montgomerycountymd.gov. If you have questions for us, it's right there on the final slide. You can come to our website. We have a lot of information available for consumers. And if you have any questions you want to ask us, our email address is there as well. So again, thank you to the panelists and for the guests for coming to our program. And we'll bid you a good night. Thank you.
Thanks, Trace. Thanks, Dan.